Buying futures is a way to trade financial instruments or commodities by agreeing to buy an asset at a predetermined price on a specific future date. A futures contract allows you to speculate on price movements or hedge against risks, offering leverage and flexibility. Futures are widely used for assets like commodities, stocks, currencies, and indices, making them a key part of financial markets. When you buy a futures contract, you agree to purchase the underlying asset at the contract's expiration date. For example, if you buy a crude oil futures contract at $80 per barrel and the price rises to $90, you profit from the $10 per barrel price increase. Futures contracts typically represent a standard quantity, like 1,000 barrels of oil or 100 ounces of gold, so the potential gains can be significant. In this case, a $10 per barrel increase would result in a $10,000 profit for a 1,000 barrel contract. Unlike buying stocks, futures require only a margin deposit rather than paying the full value of the contract. This margin is a fraction of the contract's value, giving you leverage. For instance, if the margin requirement is 10%, you only need $8,000 to control a $80,000 futures contract. This leverage amplifies profits if the price moves in your favor, but also increases the risk of losses if it moves against you. Futures are used for speculation and hedging. Speculators aim to profit from price changes. For example, if you believe the price of gold will rise, you can buy gold futures. If your prediction is correct, you can sell the contract for a profit before it expires. On the other hand, hedgers use futures to protect against unfavorable price movements. For example, a farmer growing wheat might sell wheat futures to lock in a price, ensuring stable income regardless of market fluctuations. The value of a futures contract changes daily, and gains or losses are settled in a process called mark-to-market. If the market moves in your favor, the profit is added to your account, but if it moves against you, losses are deducted. If your account balance falls below the margin requirement, you must add funds in a margin call to maintain your position. Futures markets operate on exchanges like the Chicago Mercantile Exchange, CME, ensuring standardization and transparency. Contracts have specified terms, including the quantity of the asset, expiration date, and settlement method, either physical delivery of the asset or cash settlement. While buying futures offers opportunities for large profits, it also carries risks. The leverage involved means that even small price movements can result in substantial losses. For example, if you buy a crude oil futures contract at $80 per barrel and the price drops to $70, you lose $10,000. Additionally, futures have expiration dates, so timing is critical and you must monitor your positions closely.